go to our question. Sparkler Traders, the following transactions took place during the month of February. Sparkler Traders uses the perpetual inventory system. Mr. Achar, the owner, contributed 11,000 Rand cash to start up his Sparkler shop. So what type of activity is this? This is a financing activity. Why do I say that? Well, the business, even though the owner gave money, the business is getting 11,000 Rand. So the business is getting money, and that we call a financing activity. So how do we show this in our table? Well, my assets went up because the business got money by 11,000 Rand. So there you can see my assets increased. We know that for every debit there must be a credit, so we need to find out where we're going to put this credit. So let's have a look. Where did the business get this money? It was contributed by the owner. So that is capital. So my capital account needs to be increased by 11,000 Rand as well. And there we can see that my assets is 11,000 and my owner's equity and liabilities is also 11,000. My total debits is equal to my total credits. What this means is that the net worth of this business for the owner is 11,000 Rand. So if I take all my assets, which is the 11,000 Rand cash, and I minus all my liabilities, I get 11,000 Rand that belongs to the owner. All right, transaction number 2. Obtained a loan from the bank for 20,000 Rand. Yo, so we're getting another 20,000 Rand. All the money was immediately received by Sparkler. Do you think this is going to increase my owner's equity? Well, let's have a look. We're again getting money. So this is a financing activity. We get 20,000 Rand. So you think, this is going to increase the net worth of the business. The problem, however, is that my loan, which is a liability, also increased by 20,000 Rand, thus resulting in my owner's equity staying the same at 11,000 Rand. So we can see that my assets is 31,000 Rand and my liabilities is 20,000 Rand. So in essence, my assets went up by 20 and my liabilities went up by 20. The net worth of the business remains the same. Let's have a look at the next transaction. Sparkler Traders bought an oven for 5,000 Rand. So this is an investing activity. The business is now buying assets. It's buying things that they can use to make money. So they're going to use this oven to make some nice Sparkler dishes. So let's have a look what happens. They took 5,000 Rand out of their bank account. We're assuming they bought it with cash. And they bought an oven, which is also an asset. So my literally money has just moved from one asset, the bank, to another asset, the oven, keeping my assets at 31,000 Rand and not changing my equity at all. Back to the next question. Sparkler Traders bought trading stock, bread, bologna, and potatoes during February for 4,000 Rand cash. So again, they're buying some more assets, which is an investing activity. Hold on. So the same thing is going to happen here. We're going to lose some cash, but we're gaining some trading stock. So let's see how this influences. We're losing 4,000 Rand cash. Oops. 4,000 Rand cash. There, my assets has gone down to 27,000, but we again getting 4,000 Rand trading stock, keeping my assets at 31,000 Rand. Back to the question. Let's see if this business can make some money. They sold goods on credit to a local construction site for a selling price of 2,000 Rand. Goods had a cost price of 1,600 Rand. So what's happening here? Finally, the business is making money because there's more money coming in, or at least a promise of money since it was sold on credit. They're getting a promise that they'll get 2,000 Rand in cash in the future, and they're only losing trading stock of 1,600 Rand. So in effect, they've gained 400 Rand in assets. Let's see how this works. The business is getting a debtor of 2,000 Rand, which is a promise of money coming in. Now, this is not cash coming in, but it's a promise of cash coming in the future, which is an income. So my sales also goes up by 2,000 Rand and my incomes goes up. Can you see what happened to my equity? Finally, my equity has been increased because I'm getting an income. But we need to remember that there's two parts to this transaction. Since we were using the perpetual inventory system, we also need to record the trading stock that was lost. So my trading stock increases on the debit side and it decreases on this side. So I lost 1,600 Rand of trading stock. Now, whenever an asset is used, this is an asset that has been used, we need to record an expense. The relevant expense here is cost of sales. So the money went from the asset, decreased the asset, and we increased the expense. And you can see what happened here. My expenses increased to 1,600 Rand, and my equity has now gone from the previous 11,000 Rand to 11,400 Rand, which is the difference between the 2,000 Rand debtor gained and the 1,600 Rand trading stock that was lost. Excellent. So here the business finally made some money, and we call this operating activities. The last transaction, paid the water and electricity related to the shop, 250 Rand in cash. This is also going to be an operating activity, even though we're not actually making money. It's just part of the process of making money. They had to pay the water and electricity to be able to operate the oven, to be able to sell the goods for 2,000 Rand to the customer. All right, so we're paying 250 Rand in cash. So my cash again is going down. Remember, this is assets. They increase this side, they decrease on the credit side, 250 Rand. My assets decrease. Can you see there? Assets decreased. And I've used up this 250 Rand by using the water and electricity, and therefore that's going to be an expense. 250 Rand. My expenses then total to 1,850, which is the 1,600 plus the 250. Now let's have a look at what the situation is in the income statement. I've got incomes of 2,000 Rand, got expenses of 1,850. That leaves me with a net profit of 2,000 minus 1,850, which gives me a net profit of 150. Now this 150 has been included in my equity figure. You'll remember that our equity, owner's equity, is made up of the capital figure, which in this case is 11,000 Rand. Then I also need to add, well, first I need to subtract all the drawings, but in this case there was no drawings, so I can make that a 0. Then I need to add all the incomes. The incomes was 2,000 Rand and the expenses was 1,850. So let's just get our pluses and minuses right here. The expenses was a minus. So my owner's equity total then, if you add all of this up, comes to 11,150. So you can see that the income statement of 150 Rand actually is included in the balance sheet in the equity figure. And this is how the income statement is integrated into the balance sheet, into my equity figure. Just a quick recap. You remember that we started off by a contribution of 11,000 Rand, and then we got some more money, but we also got an increased liability, so my equity stayed at 11,000 Rand. Then the 5,000 Rand that we gave out was moved to an oven that we got. Then we gave out another 4,000 Rand for trading stock. So again, nothing changed in my equity. The only time my equity changed was when I actually sold 1,600 Rand worth of trading stock for 2,000 Rand on credit. And you can see that my assets here decreased by 1.6 but increased by 2,000 Rand, resulting in an increase in my equity. And then lastly, I lost 250 Rand to an expense, water and electricity that we used, which again decreased my equity to 11,150. Hopefully you now know how a business actually makes money.